Why? Why? But why? The Fed's cutting rates and mortgages, long-term bond yields keep going up. Why? Well, been watching my videos. I've been talking a lot about how the job market is really what's driving it right now. And this morning, a whammy comes in. Basically, we have the highest yields, highest mortgage rates in a year after a strong jobs report. So 256,000 jobs were created. That beat the expectations of 160,000. Unemployment rate goes down. And to throw salt in the wound, stronger salaries, more wage growth. So that has pushed the 10-year yield up. So technically, this is a little bit of old information. A lot of the mortgage companies aren't reporting yet. But yesterday, national average 20% down good credit bumped up to 7.15. That'll probably bump up another eighth to 1/4% here by the end of the day. But it's all about this 10-year bond going up. So you can see this right here is beginning of December. And we've seen it go from 4.2 all the way up to 4.7. So as a result, of course, mortgage rates have gone up too, the similar amount. So it went up about a little bit over 1/8% today. So the job market is really what's driving it. And so a lot of people are just really questioning, like, well, how does this happen when the Federal Reserve is cutting rates? And the quick answer is there's a correlation between the Fed cutting rates, but it is not perfect. Let me show you that. So what you can see here in this red line, that's the federal funds rate. That's what the Federal Reserve actually changes. But the mortgages and the 10-year Treasury, they're more of a market dynamic, influenced by the Fed, but not directly impacted by the Fed. So you can see by the blue line, which is mortgage rates, and the red line, like, hey, they're highly correlated. They tend to overall run in the same general directions, but clearly not perfect. And certainly we've seen that most recently, where you can see the Fed has cut rates down here, the red line, but yet you see our blue line mortgage rates going up. And so three really main things are impacting that right now. One is the hot job market. Two is our government is issuing a lot of debt right now, so it's putting excess supply into the market. But three, the Federal Reserve actually has done nothing for long-term rates. So while the Federal Reserve has cut short-term rates, they have done nothing. And what I mean by that is how long-term rates are influenced by the Fed is balance sheet runoff. So we're looking at a graph from 2020 to now, basically. And you see how this all went up. Really peaking up at around middle of 2022. This is the Federal Reserve's balance sheet. Basically, they're buying mortgage-backed securities, buying Treasury, artificially making interest rates better. But now you can see that is going down. And so that means the Federal Reserve is running off their balance sheet or selling Treasuries and selling mortgage-backed securities, putting even more excess supply into the market. So while the Federal Reserve has cut short-term rates, they are actually still pushing long-term rates higher with this balance sheet runoff. A little bit of good news here. I got to leave you some good news, and is that they're likely going to be ending that this year as far as their balance sheet runoff. Some of the projections are, end of this quarter. No one knows exactly for sure, but certainly having the Federal Reserve work in our favor, working against us, can be a big thing for mortgage rates, at least moving into second quarter of this year. Thanks for watching. Of course, if you have any questions about financing home, please give us a call. Have a happy Friday.